It is officially over. For decades, we have sat in this echo chamber of global finance, whispering about the big one. We have pored over the charts until our eyes bled. We have tracked the open interest of the bullion banks like hunters tracking a predator in the tall grass. And we have guessed. We have sat through the ridicule of the mainstream media, the pet rock insults from the suits on CNBC, and the smug grins of Wall Street analysts who told us that silver was a relic of a bygone era. We told them the banks were naked. We told them that the leverage, that massive towering skyscraper of paper, promises built on a tiny foundation of physical metal, was structurally unsound. We hypothesized that the bullion banks were playing a lethal game of fractional reserve musical chairs, selling the same ounce of silver to 100 different buyers, praying that the music would never stop. We said that one day the physical market would realize it was being gaslit. We said that one day the short sellers would get caught so far offside that the entire global financial system would be forced to bend the knee to the reality of the periodic table. But until this morning, Saturday, December 27th, that was just a theory. It was a mathematical probability, certainly. It was a logical inevitability, yes. But we didn't have the smoking gun. We didn't have the body on the floor that the police couldn't ignore. We had the smell of smoke, but we couldn't point to the fire. Well, ladies and gentlemen, stop guessing. Stop speculating. Stop wondering if the squeeze is a myth or a meme, because that day is today. The theory is dead, and in its place is a cold, hard, undeniable reality. The body has been found, and it's lying right in the middle of the Federal Reserve's balance sheet. While you were glued to your screens this morning, perhaps celebrating as you watched, the spot price of silver tear through resistance levels like wet tissue paper to hit $77.16, while you were busy calculating your new net worth and thinking about the life-changing gains in your brokerage account, something much more important, much darker, and much more terrifying was happening in the plumbing of the global financial system. There's a world behind the one you see. There's the front-end market where prices tick up and down, and then there's the back-end plumbing, the interbank lending, the repo markets, the collateral swaps, the hidden pipes that keep the blood of capitalism flowing. And right now, those pipes aren't just leaking. They are bursting with the pressure of a systemic failure that the mainstream media is absolutely terrified to report. They won't touch this. They can't touch this. To report the truth of what happened this morning is to admit that the entire Western banking system is currently insolvent. We just received the official data from the Federal Reserve Bank of New York regarding their overnight reverse repurchase agreements, the repo facility, for this morning. And the number that just flashed across the terminal isn't a glitch. It isn't a decimal point error. It is a confession in cold digital ink. $17,251,000,000 in a single morning. In the quiet, exhausted hours just after the Christmas holiday, when the world was supposed to be looking the other way, the too-big-to-fail banks ran to the Federal Reserve's emergency liquidity window and begged for over $17 billion in cash. Now, you need to understand the gravity of what this means. You need to understand what the repo market actually is, because the bankers want you to think it's just boring accounting. It's not. In the world of high finance, the repo facility is the pawn shop of the last resort. It is the emergency room for a financial heart attack. If you are a healthy bank with a balanced book, you do not touch the Fed's window. You trade in the interbank market. You borrow from your peers at the market rate. In that world, going to the Fed for an emergency overnight loan is a badge of shame. It is the walk of shame of the banking world. It is the signal to every other player on the field that you are out of cash, out of options, and out of time. So why would the masters of the universe, the entities that supposedly control the global economy and manage trillions in assets, need $17 billion in cash at 8 a.m. the day after Christmas? Was it for payroll? No. Was it for some year-end operational expense? Don't make me laugh. They need it because they are bleeding to death. They need it because they just received the biggest, most violent margin call in the history of the commodities markets. The systemic crisis we have talked about for years is no longer a future event. It is a present tense catastrophe. Connect the dots. Look at the timing. It is impeccable and brutal. Yesterday, silver gapped up. Overnight, as the Asian markets opened and the London desks scrambled, silver didn't just rise, it teleported to $77. The banks are sitting on short positions that number in the hundreds of millions of ounces. They sold those contracts at $30. They sold them at $50. They sold them at $70, thinking they could tamp it down like they always do. They thought they could use their high-frequency trading algorithms to spook the retail investors, trigger the stop losses, and buy the metal back cheaper. But the retail investors didn't sell. The Chinese industrial buyers didn't sell. The sovereign wealth funds didn't sell. For the first time in 40 years, the paper smash failed. The vaults were empty, the demand was physical, and the price didn't go down. It went vertical. And right now at 77.16, the math has become the bank's executioner. Every single dollar that silver rises from here creates billions of dollars in losses on their books. But there's a massive difference between unrealized losses on a spreadsheet and a margin call from the clearinghouse. For months, the banks have been hiding. They've been using accounting tricks to pretend the hole in their balance sheet didn't exist. They've been kicking the can down the road hoping for a miracle. But the COMEX clearinghouse doesn't care about your hopes. The exchange doesn't care about your prestige. When the price moves $5 or $10 against you in a matter of hours, the clearinghouse computer spits out a cold, hard demand. You're underwater. Post the cash to cover the risk right now, or we liquidate your entire position. And send the price to $200 instantly. This morning, the computer spat out a number, and that number was $17 billion. The banks looked at their liquid cash reserves and realized the terrifying truth. They didn't have it. They are illiquid. They are insolvent on a mark-to-market basis. So they had no choice. They gathered up their U.S. Treasury bonds, the only collateral they have left, and they ran to the Federal Reserve in the middle of the night. They pawned the full faith and credit of the United States for overnight cash just to keep the lights on. This $17 billion is not a stimulus check. It is a tourniquet on a severed artery. It is a desperate, gasping attempt to stop the bleeding before the patient dies on the table. The fact that this happened on a Friday, when bad news is traditionally buried, tells you everything you need to know about the severity of the crisis. The mask has slipped. The suppression machine has broken down. We are watching the beginning of a hyperinflationary meltup, and the $17 billion repo spike is the proof that the banks have finally hit the wall. The game is mathematically over. And in the next section, I'm going to show you exactly how deep this confession goes. Now, let's step inside the yellow tape. To the average person, the person who gets their news from a 30-second soundbite on the evening news, a $17 billion repo operation sounds like a dry technical adjustment. It sounds like the boring part of banking. But you aren't the average person. You've been watching the cracks form for years. And you know that in the world of high finance, numbers are more than just math. They are a language. And right now, the Fed is screaming. To understand why this $17 billion is a confession of systemic insolvency, you have to understand what the repo market actually is. You have to understand the plumbing. Imagine the global financial system as a massive, high-performance engine. Cash and collateral are the oil that keeps the gears from grinding into scrap metal. In a healthy economy, banks trade with each other. If Bank A has too much cash and Bank B has too many treasury bonds, they do a repurchase agreement. Bank B gives the bonds to Bank A as collateral. Bank A lends the cash overnight, and the engine keeps humming. This is the interbank market. It's private, it's efficient, and it relies on one thing: trust. But what happens when the trust evaporates? What happens when Bank A looks at Bank B's ledger and sees a smoking crater where their silver short position used to be? Bank A says, "I'm not lending you a dime. I don't care how many treasuries you have. You're underwater on your silver shorts, and if I lend you cash tonight, you might not be around to. Pay me back tomorrow morning." When the private market says no, the failing bank has only one place left to go: the Federal Reserve's emergency repo facility. This is why I call it the pawn shop of last resort. You don't take the family silver, or in this case, the U.S. Treasury bonds, to the pawn shop because you're having a great month. You go there because the electricity is about to be cut off. You go there because the masters of the universe are effectively standing at a bulletproof glass window at 8 a.m. on the day after Christmas, pushing their government bonds through the slot and begging the Fed for enough cash to cover their margins. The number that flashed across the terminal, 251,000, is the exact size of the hole they couldn't plug with private money. It is the measure of their desperation. Now, look at the timing. Why now? Why Friday, December 26th? In the banking world, bad news is always buried on a Friday. It's a tradition as old as the Fed itself. You seize banks on Fridays so the public has the weekend to calm down. You drop catastrophic data on Friday afternoons so the smart money can exit while the retail public is busy watching football or shopping for post-holiday sales. They were hoping this would slip under the radar. They were hoping that because the trading volume was low, nobody would notice the Fed printing $17 billion to bail out a silver short. But we noticed. We are watching the terminal, and what we are seeing is the total breakdown of the suppression machine. For 4 decades, the scheme worked like a charm. It was the perfect crime. The banks would sell paper silver, contracts for metal that doesn't exist, to push the price down. If the price started to rise, they would just sell more paper. They had an infinite supply of digital ink, so they could always win. They could overwhelm the physical buyers with sheer volume. But there is one thing that kills that scheme: a liquidity crisis. The paper game requires margin cash. As the price of silver moves up, The cost of holding those short positions moves up exponentially. You can print infinite paper contracts, but you cannot print the cash needed to satisfy the COMEX clearinghouse's margin requirements. You need real dollars for that. This $17 billion represents the bottom of the barrel. It represents the precise moment where the banks ran out of their own money and had to start using your money, the taxpayers' money, via the Fed's printing press, to fight the silver market. This changes the entire dynamic of the trade. We are no longer just fighting JP Morgan or Citigroup. We are now fighting the Federal Reserve of the United States directly. The Fed has officially stepped in to become the counterparty to the silver squeeze. They have effectively subsidized the short position to prevent the COMEX from defaulting. But here's the catch, the part that should have you grinning from ear to ear. Even the Federal Reserve, with all its power, cannot print physical silver. They can print trillions of dollars to keep the bank's hearts beating, but they cannot print the 5,000-ounce bars needed to satisfy the industrial demand coming out of the East. In fact, this bailout makes the situation worse. Think about the irony. The banks needed cash because the dollar is losing value against silver. The Fed's solution? Print more dollars. They just injected 17 billion brand new inflationary dollars into the system. What does that do? It devalues the dollar even further. It adds more high-octane fuel to the inflation fire. It validates the exact thesis that is driving silver to $77 in the first place. It is a self-defeating feedback loop, a doom loop. The more they bail out the shorts, the higher the price goes. The higher the price goes, the bigger the next bailout needs to be. This $17 billion is just the first tranche. It is the tip of a massive systemic iceberg. If silver goes to $80, which could happen before the market closes today, that $17 billion won't be enough. They will need $20 billion, then $50 billion, then $100 billion. We are seeing the exact same pattern. Repeat that we saw in September 2019, right before the global financial system seized up. Back then, the repo rates spiked, the Fed panicked, and a few months later, the world was flooded with emergency liquidity. But this time, the trigger isn't some nebulous interbank lending freeze. The trigger is specific. The trigger is shiny. The trigger is silver. This is a hard asset rebellion against paper promises. The G-SIBs, the global, systemically important banks, the whales who told you silver was a pet rock, are now pawning their treasury bonds to survive the pet rock's revenge. This is the ultimate vindication. They are trapped. They're insolvent on a mark-to-market basis. They are zombie institutions now, existing only because the Fed has them on a life support drip. And as every horror movie fan knows, zombies can't stop a living, breathing bull market. The $17 billion is the receipt. It is the proof that they are terrified. And in Section 3, I'm going to show you the brutal mathematics of the margin call that is currently tearing their balance sheets to shreds. Do not let the sterile language of liquidity operations or regulatory capital bore you. That is exactly what they want. They want you to think this is a high-level math problem that you aren't smart enough to solve. But I need you to look past the jargon and understand the raw, brutal, and unyielding mathematics of what is happening to these banks right now. We are talking about leverage. In the world of the COMEX, leverage is the God mode button that the banks have used to rule the market for 40 years. But today, that button is stuck, and it is firing in reverse. You have to remember how the mechanics of a futures contract actually work. One single silver contract represents 5,000 ounces of metal. When a bank sells that contract short, they are promising to deliver 5,000 ounces. But because of the magic of margin, they don't have to put up the full value. They only put up a tiny fraction, usually about 10%. This is the secret to their power. It's how a bank with a few $1 billion can control 1 billion ounces of silver. They sell paper promises they couldn't possibly fulfill using leverage to overwhelm. The price discovery of the physical world. It is the definition of a naked short. But leverage is a double-edged sword, and it has no master. Let's run the numbers on a hypothetical too-big-to-fail bank. And trust me, these numbers are conservative. Let's say a major bullion bank is short just 10,000 contracts. In the world of global bullion desks, 10,000 contracts is a standard position. 10,000 contracts multiplied by 5,000 ounces equals 50 million ounces of silver. Now, do the math with me. If silver moves up by just $1, that bank on that one single position loses $50 million. A $1 move equals a $50 million hole. Now look at what happened in the last 24 hours. Silver didn't move $1. It didn't even move $2. It gapped from $72 to $77. That is a $5 vertical move in a heartbeat. For our hypothetical bank, that is a $250 million loss before they even finished their morning coffee. And that is just one bank on one position. When you aggregate the entire commercial short position, the Big Four U.S. banks and the Big Four international bullion banks, we are talking about hundreds of millions of ounces. We are talking about billions of dollars in losses accumulating in real time, ticking up every second that the spot price stays above $70. Here is where the unrealized trap turns into a death sentence. Bank CEOs love to go on CNBC and tell shareholders, these are just paper losses. We haven't closed the trade. The price will come back down and we'll be fine. They treat the market like a casino where they have infinite time to wait for the roulette wheel to spin their way again. But the clearinghouse is the pit boss. And the pit boss doesn't care about your long-term strategy. The pit boss cares about the chips on the table right now. This is called mark-to-market accounting. Every single night, the exchange calculates the value of every position. If the price moves against you, they don't wait for you to realize the loss. They reach into your account and take the cash to cover the difference. It is an automated, heartless process. So when silver hit $77.16 this morning, it wasn't just a bad day for the banks. It was a liquidation event. The $70 price point is critical because it represents the mathematical point of no return for their internal risk models. At $77, the losses exceed the cash buffers these banks keep on hand for daily operations. Their value at risk, VAR models, the complex algorithms designed to prevent a collapse, just blew up. The red lights started flashing in the risk management. Offices from New York to London. That is why they needed the $17 billion. It wasn't a loan to expand their business. It was the ante to stay in the game. It was the cash they had to hand over to the clearinghouse just to prevent their positions from being forcibly closed. Because think about what happens if they don't pay. If the clearinghouse doesn't get the cash, they take the bank's short position and they cover it. They go into the open market and buy back 50 million ounces of silver at any price. If that happens, the silver price doesn't just go to 80. It goes to $200 in a matter of minutes as a buying vacuum is created. The banks are currently in a state of technical insolvency. If they had to liquidate their short positions today, if they had to actually buy back every ounce they owe at 77, they would be bankrupt. Their equity would be wiped out. They are walking corpses, kept upright by the Federal Reserve's $17 billion emergency wire transfer. But here's the thing about math. It is cold, it is unyielding, and it doesn't care about the Federal Reserve. The $17 billion buys them time. It buys them another day of pretending they are in control. But it doesn't solve the problem because the problem isn't just cash. The clearinghouse demands cash for margin, but the longs, the people on the other side of the trade who bought those contracts, they don't want your cash anymore. They've seen the Fed printing press in action. They've seen the inflation data. They don't want a settlement check. They want the metal. And this is where the brutal mathematics of insolvency turns into the brutal physics of impossibility. Because while the Fed can digitally manufacture $17 billion in a nanosecond, they cannot manufacture a single atom of silver. In Section 4, we're going to look at the delivery crisis that is currently breaking the back of the COMEX and why the Fed's $17 billion is actually making the silver fire burn even hotter. This is where the tragedy turns into a farce. This is where the Federal Reserve, in its desperate attempt to save the too-big-to-fail banks, has officially stepped into a trap of its own making. It is a mathematical cul-de-sac from which there is no escape. I call it the inflationary doom loop, and if you understand this mechanism, you understand why the $100 price target for silver is no longer just a bold prediction, it is a policy mandate. To the suits at the Fed, the $17 billion wire transfer this morning was a stabilization measure. They think they are putting out a fire, but they are trying to put out a fire by smothering it with dry stacks of 100 bills. Here is how the loop works, and it is as brutal as it is simple. Step 1. The liquidity injection. The banks are insolvent because silver hit $77. They can't meet their margin calls. To prevent a systemic collapse, the Fed prints $17 billion out of thin air and injects it into the repo market. This is fresh money. It didn't exist yesterday. It is a pure expansion of the monetary base. Step 2. Currency debasement economics 101. When you increase the supply of a currency, without a corresponding increase in the goods and services that currency can buy, the value of each individual unit drops. 1. By printing billions to save the silver shorts, the Fed is actively debasing the US dollar. They are diluting the blood of the economy to keep the bank's hearts beating. Step 3. The hard asset response investors aren't stupid. They see the $17 billion spike. They see the Fed's balance sheet expanding again. They realize that the Fed has prioritized the survival of the banks over the stability of the dollar. So what do? They flee the dying currency. They run to the only lifeboat that cannot be printed, diluted, or debased. Physical silver. Step 4. The price spike. As investors pile into silver to escape the devaluing dollar, the price of silver rips even higher. 2. It goes from $77 to $80, from $80 to $85. Step 5, the bigger margin. Call now, we are back at the beginning, but the fire is twice as big. Because the price of silver just went up another $8, the bank's short positions are even further underwater. Their losses have expanded from $17 billion to $30 billion. Step 6, the cycle repeats. The banks go back to the Fed window. They need more cash. The Fed prints more money. 3, the dollar drops further. Silver rips higher. Do you see the trap? The very act of saving the banks makes the silver price go higher, which makes the banks even more insolvent. They are caught in a feedback loop where their own survival reflex is pushing the price of the metal they hate to the moon. They are trying to stop a flood by pumping more water into the room. But here is the most terrifying part of the doom loop for the Fed. They have lost the credibility premium. For decades, the dollar was supported by the belief that the Fed was hawkish on inflation. The world believed that if things got too hot, the Fed would raise rates and tighten the belt. 4. But today, the Fed admitted that they cannot tighten. They proved that the banking system is so fragile that a $5 move in a pet rock commodity is enough to threaten its solvency. By bailing out the silver shorts, the Fed has effectively placed a Fed put under the silver price. They have signaled to every hedge fund, every sovereign wealth fund, and every billionaire on the planet that they will provide infinite liquidity to prevent a bank failure. And in an environment of unlimited liquidity, hard assets have no ceiling. The Fed is currently sacrificing the integrity of the US dollar to protect the suppression machine. But the machine is already broken. You cannot print silver. You cannot manufacture a physical delivery in a digital printing press. Every dollar they print to bail out a bank is just another reason for a Chinese industrial buyer or an Indian jeweler to demand physical delivery. We are watching a hyperinflationary melt-up localized specifically in the commodities market. The contagion is no longer just financial, it is psychological. The market has realized that the Fed is no longer the lender of last resort. They are the bailout of last resort for a failing paper scheme. This is why the $100 wave is unstoppable. The Fed's own desperate actions are the very energy that is propelling the rocket. They have turned the US dollar into a sacrificial lamb for the COMEX. And in the final section, section 5, I'm going to show you what the end game looks like. We are moving into the unobtainium phase, where the price on your screen becomes irrelevant because the metal has completely disappeared from the vaults. We have reached the end game. We have moved past the market correction, past the liquidity crisis, and straight into the final, most violent stage of a collapsing paper regime, the unobtainium phase. This is the moment where the financial world splits in two. On one side, you have the paper price, the digital number flickering on your screen at $77, $85, or $100. On the other side, you have the physical reality, the actual metal that is currently disappearing from the Earth's surface. In the unobtainium phase, these two worlds stop talking to each other. They decouple. They divorce. The $17 billion wire transfer from the Fed was the signal that the banks can no longer settle their debts with their own reserves. But as we've discussed, the Fed can wire cash, but they cannot wire silver. And right now, the longs, the industrial giants, the sovereign wealth funds, and the smart money whales are calling the banks bluff. Look at the COMEX delivery reports. This isn't just a high number, it's a run on the bank. Over 63 million ounces are currently standing for delivery. To put that in perspective, that is roughly 8% of the entire annual global mining supply, demanded in a single month during a holiday week. These aren't speculators looking to flip a paper profit. These are entities that look at the $17 billion bailout and say, I don't want your devalued dollars, I want the metal, give me my bars. And here is the terrifying truth the bullion banks are hiding. The cupboard is bare. For years, they have used the registered inventory in the COMEX vaults as a psychological weapon to prove they have plenty of metal. But we have tracked the drain. We saw the metal moving from registered, available for delivery, to eligible, owned by private parties. The available silver is at historic, catastrophic lows. When those 12,177 delivery notices are presented to the banks, and the banks look into an empty vault, the system hits a hard wall. This is when the exchange enters force majeure. They will try to settle your silver contract in cash. They will offer you a check for the spot price, plus a small inconvenience fee. But once that happens, the game is over. The moment the world realizes you can no longer get physical silver for a paper contract, the spot price becomes a lie. It becomes a ghost. Why would anyone sell a physical ounce for $77 when the exchange itself has admitted it has no metal left? This is when the buy button disappears. We saw it with GameStop, but this is 1,000 times larger. This isn't a single stock. This is a foundational monetary asset. You will log into your brokerage, you will see silver at $100, and you will click buy, and the order will be rejected. You will call your local coin shops, and the phone will just ring. You will check the online dealers, and every single product will be marked out of stock. We are approaching the moment of hyper-backwardation. This is where the price of silver today is worth infinitely more than a promise of silver tomorrow. In this phase, the price targets we've talked about, the $100, the $150, they become irrelevant for the buyers because you simply cannot get in. The doors are locked. The lifeboat is full. The $17 billion from the Fed was the last flare gun in the night sky. It was the admission that the paper shield has shattered. The banks are now zombie utilities, existing only to process the Fed's inflation. They have lost the power to suppress, and they have lost the power to deliver. So, what is the final move? You must realize that you are no longer an investor in a market. You are a holder of a strategic asset in a systemic collapse. Do not sell your physical metal for fiat currency that is being printed by the billions to bail out the very people who tried to bankrupt you. When silver hits $100, do not think in terms of taking profits in dollars. The dollar is the burning building. Silver is the exit. In the unobtainium phase, wealth is not made. It is transferred. It is transferring right now from the entities that held paper promises to the people who held the periodic table. For 40 years, they gaslit you. They told you silver was a pet rock. They told you that you were a conspiracy theorist for watching the repo market. But today, you are vindicated. The $17 billion is your receipt. The 77 price point is your proof. And the $100 roadmap is now a policy certainty. The game is mathematically over. The banks have surrendered to the Fed, and the Fed has surrendered to inflation. The only thing left is the physical reality of a world that has run out of its most undervalued asset. Secure your position. Hold the line. I'll see you on the other side of the $100 wave. I'm Jon AG. Like, subscribe, and share this message before the algorithm buries it. The silver squeeze has only just begun.